Good turnaround Tuesday, Warriors. Are you ready for it? Hi, Michael. How are you? Brand, the Trading Warriors Untie with pictures of beers. You bet. Don't drink and trade. Okay. You did it on purpose. Okay. See if I was alert. Good morning, Mary. How's everyone doing today, team? How's it going?
Good morning, Blake. Good morning. Hey, good morning, Dale. Sorry, good morning, everybody. Good morning.
So, dollar giving it back?
Yes, sir.
All right. So, temporary or a resumption of the trend?
Ranges until tomorrow's CPI, I think.
Yeah, probably, yeah.
Was about my feeling yesterday when the US came online, trading a bit of the NFP, and then now we're back to where we started, really. Some euro is doing pretty okay and sterling pretty okay on the crosses side, but versus dollar, I think tomorrow will be our next appointment. We've seen it basically in everything, right? Yesterday we tried the downside on the equities, but we are back. S&P is back at 4100.
Oh,
4110.
Yeah, there it is.
Yeah. Yeah, so that first level 70-75 is holding.
Yeah.
And the top side is for the time being relatively capped as well. We will see what happens today, but I find it hard to find the trend, at least for now, in the short term. And I guess we just have to trade it as it comes. Yields, same ditto, corrected. The short end back to 4%. US 10s back to the 341 in the middle of decision zone if there is a decision to be made. And here we are.
Okay. I made one discovery, and you know, it's interesting how sometimes you make these discoveries after you're on the wrong side. But when I thought gold silver ratio was bottoming out here around this 84, then later on I noticed, you know, this was a big level, and this sure looks like a head and shoulders top, and it's 96. It's basically 86 to 92, which would give you a target of 80. Here we are. Yeah, so you know, one of those after the facts, you see it.
Yeah,
that ever happened to you? Huh?
And it's perhaps also telling that we're trying to stabilize in both gold around 2K and silver around $25, and waiting for what's to come, you know.
Well, this was silver way outperforming gold. Okay, that's why silver was, you know, huge. So this would be a turn, would be that it would turn, and it, you know, when I look at silver, you know, look at this. I mean, even if we still make a new high in silver, that's pretty glaring.
Yeah, if it goes back below 24.5, we're probably going to correct, right?
Yeah, that's an important area.
In the meantime, let's wait and see. Perched around 25.
All right, so we'll wait for that.
The yen is done exactly the same. .yen stopped dead in my 133.80, 134 the figure zone. And we are now back somewhere hanging around 133 and waiting.
Yeah. I would say I'd favor buying a dip here, you know, even if we get a good number and yields drop. When you favor buying a dip, maybe 32-ish.
Yeah, me too for now. But I'm rather in euro yen, because I really don't have a clear view on what's to happen with the dollar before tomorrow's CPI, you know. And then at the end of the week, we were talking about that on the Flow Show as well. At the end of the week, we'll have the earnings season starting as well in the US. Could be a pretty hectic week, the second part of it. So from the CPI tomorrow, then into earnings. So the dollar side is a bit unclear, but
Yeah,
we have to.
another false signal. At least for now. I mean, I readjusted this trend line a few times, but you know, we took it out. We're back underneath. We're I think I don't know, Stell calls this no man's land.
Yeah, that's your indecision territory, right? Right now.
Yeah, yeah.
But
I
we
mean,
have
I
to
could see
know.
it doing this again. Back down here again for
Well,
another shot.
I was just going to say, if you look at the two major components, we have to note that euro found support relatively quickly around that 108.30.
Yeah, it did.
Everybody was buying dollars, and cable as well in the mid 123s, and they're back to. We're not back at breaking territory. I wouldn't call it a breaking territory anymore, but they jumped back relatively easily, I would say.
Okay. I brought up Apple before the stock opening yesterday, and then there was some news about, I don't know, getting some supplies. I mean, this is a China trade for me, and you know, so far, you know, that was a pretty good gap. We'll see if it could fill it, even if the S&Ps, which it wouldn't surprise me if they tried last Tuesday's highs up here, because you know we did confirm. So we'll see. But Apple, I think, has a worm. It has a worm in it now. So this is a big. I mean, the hugest stock market cap wise, and people almost look at Apple as being how they would view treasuries or bonds years ago, as a great place to park. You never get hurt, and for the most part, they've been right. You know, um, you look at Apple, and you know it's been pretty contained during this bear market we've had in equities. I guess we lost what 20? We lost 30% down here, but you know we're threatening to break out to new highs. I think we're going to fail here, but this is where so you know the averages would really take a hit if this came under pressure, and then I call Microsoft the next big one to pay attention to, and that doesn't look great. Here's the semis, 4 hour, and they're getting upgrades by a few brokers today. So we'll see if they could drive it for a 3, or maybe it's a failing rally here. But Microsoft is something else that, you know, everyone has to pay attention to if you're not long Bitcoin. So looking for Mr. Softy. Here's coin. So, you know, you have Bitcoin at new highs. You have coin maybe being able to fill a gap. So short coin on this Bitcoin rally. And then I just can't find Mr. Softy. All right. Anyway, I guess we could get back. We may as well talk about this. So, you know, broke out the triangle. It's confirming on most time frames. But if this is a 4, this is a terminal thrust. So, you know, look for a false breakout. If we get back under, say, you know, 29,000, you'll know the Bitcoin run is over. And that's got most of the market's attention right now. It's something making a new high, you know, something making a new high or something making a new low always gets the market's attention. Yeah. Oh, here we go. All right. So here's Microsoft. All right. So we last week we tested this breakout and came on rallied pretty good. Look at this.
Will it push on right now or wait for the earnings season?
Well, I would just go with price. You know, I would you know, what you really should do as a technician is just wait for it to give you a false breakout, which would be back under 282. You know, kind of like we just saw silver 25.5. That, you know, I've spent many years trying to anticipate false breakdowns, false breakouts, and you're better off, as Steve talks about all the time, waiting for the signal. You know, you try and get a lead on a signal, and that's not the trade. The trade hasn't happened yet. It's only happened in your imagination. Let it happen on your screen. How about that?
Yeah, trying to trade breakouts is not a lucrative strategy over the longer term.
Yeah. Let's bring some other guys in to talk about what they're seeing before tomorrow. Stell, how are you today?
Good morning. I'm very well, thank you. All good.
You are very well. And so
yeah.
what do you think of that analysis of the gold silver ratio? Does it look
Well,
stretched to you anyway?
Well, we talked about this earlier today, and I think for the past few days we've been saying that they are both gold and silver are kind of consolidating at pretty major points. So the chance of a pullback, given how bullish the crowd is, you know, if you read 10 pieces on 10 posts on markets these days, you know, 3 of them are about bullish metals. So, which you know, I think they're right, but for timing this, I think now is not the time to get into it. You know me, I am long silver, added my second position roughly here, but I already had the long from 21.5. So I have a little bit of leeway to play around with that position. But, you know, gold at 2K, silver at 25, silver seems to be breaking, but with CPI tomorrow, anything can happen. So, I think your analysis on the gold silver ratio is spot on, and that, you know, head and shoulders measuring down to 80. Well, we are there, but let's not forget, even if everybody is bullish something or bearish something, if the markets and the fundamentals dictate it, they can keep going. And remember, a very good example is bonds. Remember when bonds started selling off a lot, and after a while, you know, everybody got on the bandwagon, and they just kept going. They kept going, and then they stopped, obviously. But, you know, a move can keep going for longer, even if it's overbought or oversold. But tomorrow is going to be the big one, the next appointment, like Kay said, or maybe disappointment. Oh, I love these word games.
Do you think we're not gonna get a good number tomorrow?
My view remains the same. I still think we're going to be disappointing on the weak side on US inflation. And it happened last time, albeit just by 0.1, if I recall. But we are now expecting a big drop from 6% to 5.2 year on year. The core is expected to be roughly steady. So we need to be looking at core, but you know, core excludes food and energy, right? So these are important things. I'm not focusing on core like other people are. You know, just because something is volatile and it's bringing volatility to the number, it doesn't mean you shouldn't be paying attention, especially given that it's the most important part of the number for me. So I think for choice, we probably disappoint by 0.1, 0.2 or something like that, even though we are pricing a steep drop. But, you know, going back to metals, I think that we are ripe for a little correction now. And especially if tomorrow's number does not disappoint, then the correction is definitely coming.
Okay.
So, yeah.
And all right, I just wanted to show this to our viewers that we're setting up a 3 drive right here in wheat. So could be a good hedge. You know, wheat's been under pressure for over a year and a half, just like oil has. The highs were made on the invasion. Almost, you know, looks like crude. You had the first break, then you had the failing rally, and it looks like crude. Okay, so maybe crude is a foreshadowing of a turn in wheat. chart patterns, I didn't realize it till now, are pretty identical, right? So, you know, there's wheat, and this is what, the weekly? Yeah. And here's, huh?
Yeah,
Why
they're
would
pretty similar. Yeah.
Yeah, why would wheat and oil have a similar chart formation? Unless it was, you know, I don't know, because it was war related.
They're both commodities, and
Yeah.
they are affected by. Yeah, I mean the wheat producers. I mean they are both affected by Russia, Ukraine. So
Yeah.
kind of makes
Okay. Well,
sense.
yeah. So then, you know, if oil is turning good for a rally to 90.95, there could be something to do in wheat too, because I mean, wheat fell a long way from where it was. So even just fib retracements could be decent trades. I'm going to bring Blake in here to make sense of the breakout in the trend line break in the dollar, and if you now think this is another false breakout, Blake.
Well, that and good morning, everybody. How's it going,
man? Good morning.
Really quick, I just wanted to say and concur with you guys this morning. And I was listening to Stelios just saying that, hey, we're really dependent on what happens tomorrow. Kman's like, I don't have much of a bias. It's hard to have a lot, too much of a bias coming off of a long holiday weekend, and knowing that CPI is tomorrow. And if you look at the dollar, as Dale was just pointing out, the dollar this is the trend line you were focused on, Dale, right here. Mm-hmm. Right? We're obviously back testing it right now, and that happened just because I moved it, but that trend line is right there. Okay. But the bigger resistance that held was this channel resistance that you can see here. And that held yesterday, and that was significant. We were, if you used ForexAnalytix, you got that update yesterday on the dollar index right here. Yesterday, it was the intraday update. The dollar index is at descending trend line from March and 7th. And if we break the 102.30 level, then we'll see a bit of a dollar recovery. The dollar recovered. Then we stalled at the trend line, and as you can see, that trend line was noted right here. The problem that the dollar has is, as Kman said, or as Stelios was just saying, is that we do have CPI tomorrow, and CPI is going to be a big deal. I think the whole market is just assuming that the China reopening is just continuing to usher in a lot of deflationary or disinflationary forces, and we're going to see that continue to deteriorate. So that's not going to be a problem, and the Fed will have the flexibility of possibly cutting rates sometime in the second half or the back half of 2024 if we need it. But as you all know, it's not that. It might be a little bit trickier than that, and I think equities are going to, and the markets are really going to respond to what we see tomorrow. You bringing in a great guest today, Dale, with Eric Bosmajian, ahead of the CPI data. He's got obviously a very, very good macro outlook on the market, and I think he's going to have a lot to say about the inflationary pressures. I'll tell you, Eric is one of my favorite people, macro guys to listen to, so I'm going to be sticking around for that interview today. So make sure you all are doing
Same
that
here.
as well. Yeah,
I think I will too.
Yeah, hey, you should stick around for that.
You should definitely stick around.
Yeah,
Right,
Dale. Because if you don't stick around, then we got some serious problems.
I think I want to hear him too.
Yeah, so I want to also point out that yesterday was a holiday, and we had, like, you go back to the dollar and you see this just kind of move higher in the dollar. It was like an insatiable recovery in the dollar yesterday. And notice how we gave it all back. I want to take you over to last night in the ForexAnalytix chat room. So if you guys don't know how to get to the chat room in ForexAnalytix, it is right here. If you're logged into ForexAnalytix, right there's a little button up here next to your avatar that says go to chat room. This is what our chat room looks like. And one of the things that I pointed out last night before I left, and I said one of the things post holiday trading is that we revert back. Just keep that in mind. The U.S. dollar strength may come back in European trade, just FYI. Not all the time, but a strong possibility. And that's exactly what happened. You saw Asia come in, and the dollar just got sold all the way through European trade. Now here we are, obviously, ahead of the data. And by the way, that was last night. You can see all the chatting that's happened since then. This is all, since I was asleep, until I got up just recently. So you can see right here. And then, we're all in there chatting. So it's really one of the most active trading communities around the clock that you can be in. So just to let you guys know, if you're not part of the ForexAnalytix community, try it out. It's only $1 for 10 days. Anyway, but I think today, a day ahead of the data, it is going to be a little bit more difficult to gauge. You look at the S&P. The S&P is stalling around the 618 retracement. Notice how we're bouncing at really critical support. This 4070 support is it's really key. And then we have channel support just below that. So I can't really be bearish equities until we get below this channel. But
where do they intersect? At what price on the
it's
chart?
40.35, I think.
40.80,
maybe 40.50. Yeah, 40.50.
Okay, 40.5. Thank you.
Yeah, 40.5. You look at the Dow struggling at the 618 retracement and also channel resistance. So, and then the NASDAQ's just kind of like the S&P is just kind of holding up as well. The Russell's trading really heavy and still trading pretty heavy. I mean, you look at the Russell 2000 now, obviously it's, a lot of the banks are weighing on this right now. But that doesn't give me much confidence when you see that Russell 2000 trading as heavy as it is. We can't even get, past the 38% retracement where you got, other indices that look so much better. And one of the things is when you have like certain indexes underperforming, immensely, all that tells you is there really is just rotation in the market. It's not like a rush for the exits either. You're not seeing this massive
GMO.
Yeah, get me the fire, whatever you want to say. So that's one thing that I think we should also be paying attention to, is that it is just all pure rotation right now. There isn't a massive rush for the exits. And here's yields. Yields ain't giving us a whole lot. It looks like we're in this descending channel. Had a nice little head and shoulder pattern here. We keep hitting new trend lows, but nothing significant. So it's probably actually more or less turning into a wedge than anything else. But that's one other thing. This is it. This is one of the things I want to talk about today too. How many of you guys, and it's this is probably a silly question here. How many of you guys are bullish risk right now? You think that stocks are good value and we're going higher right now. Does anybody think that we're that the market's going higher? Not everybody can be bearish. Dale, you're bearish. I'm bearish. But is there who's not?
It bothers me. And you know what else I saw is that hedge funds have never been this short SPX since 2011.
Yeah, that's scary, right?
Yeah,
but wouldn't you say that some of that covering's been done as of last week? I
just saw that news this morning. So
that's regurgitated. I don't know. But yeah, it does make me a little nervous, right? I agree with you.
Yeah, a lot of company.
What do you think, Stelios? I heard you say something
about stocks.
About risk.
Well, I think that we're going to see 4,200 first in the S&P before we do anything else. It doesn't make too much sense, but I think that's what's going to happen, because if something can't go down with a lot of things conspiring or basically showing a downward direction, theoretically, right? The situation is not great for risk at the moment. If something can't go down on all that, it has to go up.
Okay. Yeah. It's like the beach ball underwater analogy that we've been using for 15 years.
Yep.
Right.
Melt up. Dave H. Contrarian.
Yeah. I mean, can I be contrarian or the contrarian? Is that is that possible?
A lot of people are. Yeah.
Steve, what are your thoughts here?
I've been saying the same thing for weeks now. I'm very skeptical about the bearish case scenario, not from a fundamental perspective. The problem is that fundamentally speaking, it makes a lot of sense. Technically speaking, though, I think that nothing points to bearishness at the moment. Nothing on the chart. And in combination with the fact that any type of rally is going to really be a hated rally for the aforementioned reasons, a lot of people logically support the bearish case scenario, makes me extremely skeptical about the downside. I see a lot more likely to first squeeze all these people out before anything bearish happens.
Yeah. Well, George just brought up seasonally speaking too. And I hear you guys like chiming in the chat. Look, I'm a big sell in May, go away person. It's a seasonality trade that I've seen 70% of the time. I'd say in the last, if I had to throw a number on it, I'm not a statistician. If we go back to, I don't know what, 30, 40 years worth of data that I can remember trading through, or 20 some odd years, nearly 30 years. I would say 70% of the time we see that happen. There are anomalies, but seasonality, you just get a lot of people that are taking the summer off. They just want to exit. Then we see them come back after into the fall. Sell in May and go away. I think that's real. And I think in today's market, it's going to be even more real because of, no one wants that exposure over the summer. So I think it's going to be a bigger issue this year. Now, with that being said, there is something in the currency market that actually is really a big warning to long-term bulls in the equity markets. And it's one of the cross rates, or a few of the cross rates, that I love to look at and I love to watch quite a bit. I'm going to take you over to them really quick. Take a look at the Euro Kiwi. This is a breakout here. Look at the daily candle. That's a breakout. Euro Kiwi. Look at the pound Kiwi. The pound Kiwi just broke out above this wedge resistance. Looks like we have some higher levels to go. Look at the Euro Aussie. The Euro Aussie looks like we're going to break out here. We start breaking this horizontal resistance over here around 165. That's a like serious breakout, right? Look at the pound Aussie. Okay, pound Aussie also forging new trend highs. Now, this is all a big deal because let me pull up a different feed here. I'm going to go up to Euro Aussie. Let me pull up something that I don't usually use. Let's use this feed. Okay, let me delete this really quick. And let's put in the S&P and let's look longer term. Okay. So, this is the that's not what I want to do. I want to do daily chart. Daily chart's going to be better. Okay. So here is a daily chart of the Euro Aussie. Let me see if I can push that down just a little bit. You can see here, okay, over time, and especially if you go, I'll go back. This is probably a better indication. Just kind of go back and get rid of COVID, right? You can see over time, the Euro Aussie tends to be inverse of the S&P. Now you can do this with any of the other markets, right? And the premise is simple. You have commodity currencies, which tend to underperform during periods of stress in the markets. Commodity currencies such as the Australian dollar, New Zealand dollar, Canadian dollar, whatever, emerging market currencies you can throw in the same bucket. They tend to underperform when there is risk aversion, when you're thinking about lower growth, and when you get a currency like the euro, which up until recently, the euro was a great carry currency, and it still is. You look at the euro Mexican peso, it's still a good carry type of currency. When those currencies get hit and they are favored over commodity-based currencies such as the Australian, New Zealand, Canadian, or emerging market currencies, when that happens, it is a signal of risk off. It's like a kind of undercurrent in the FX market that we feel. And so I think that if you trade equities, if you are a risk on and you think that stocks are going to continue to recover, just keep an eye on these commodity currencies. If they continue to underperform, we might have the FX markets canary in the coal mine, starting to show up. Anyway, I just realized what time it is. Hey guys, we have Eric Bosmajian. He's coming in right now. But make sure you guys check out the Trader Funding Program if you want to learn how to trade our money and you don't want to risk your own money. Because in this market, in this environment, if you want to risk somebody else's money, check out the Trader Funding Program. We have different account values that you can access, from $25,000 trading accounts to $1 million trading account. You have to take an assessment because we just don't give our money to anybody, but you get included in the ForexAnalytix at the same time. And if you want to learn more details, just watch this little 2-minute video right here at the very top. Check it out on.
It's a good
YouTube.
shot. Do it.
Yeah, check it out. All right, guys. I'll see the rest of you guys and gals in the chat rooms, and then we'll see you on the morning edge for the ForexAnalytix traders. We'll see you in 45 minutes. And I'm going to sit around, though, and listen to Eric, because it's always great having Eric here.
Okay. Thank you, Dream Team. Welcome back to F.A.C.E, Eric.
Hey, guys. Thanks for having me back.
All right. So you got a big build up. You got a big build up from Blake. So I hope you don't feel too much pressure that you have to be really.
I know you're putting me on the spot here.
Can you handle it, buddy?
So yeah, I think what I'll do is I'll run through a couple of slides here.
All right.
And then maybe you can just stop me along the way if you have a question or something's confusing. Because if you have a question, everyone probably has a question, and it'll help maybe get my point across.
Well, let
here.
me lead it off with a question before you go to the slides.
Sure.
Something we're talking about. And I get your emails and I'm reading your stuff, and I agree. And I think that what happened with SVB is going to create a credit crunch as well. How is it possible for the market to go down when everyone's bearish because of the fundamentals? And do you think that eventually these fundamentals are going to catch up with the market that seems to be levitating?
Yeah, so I think that as I go through some of these slides, we'll sort of contextualize the pocket of the market that we're in right now in terms of the economic cycle, and why it's not really unusual that the market's going up, and we'll quickly realize why this is the most dangerous period. So as you know, Dale, and the people who have been following my work, and from my last several appearances on the show, I've been quite bearish about the direction of the economy, and suggesting that the economy would go into recession sometime at the end of last year or the beginning of this year. It's been my forecast for quite some time. But now we keep hearing people say, well, it keeps getting delayed and it keeps getting delayed. So what I wanted to do here was try and refine the timing a little bit more and clarify the fog of these cycles, because we, as a collective market, never realize the economy's in recession until many months after. And the NBER doesn't tell us until over a year after. So we have to do a better job of trying to assess when exactly the economy descends into recession, because it's quite often that the economy goes into recession and the market doesn't realize it for many months. The best example, the most recent example, would be the 2008, which is that the economy went into recession in December of 2007. And then the market rallied all the way to within 8% of its all-time high in May of 2008 after several banking events not dissimilar to what we've had today. So the market does have a tendency to shrug off some negative news when the recession
Great analog, buddy.
already underway. So my process involves, as you know, Dale, tracking leading economic indicators and coincident economic indicators. As the name suggests, leading economic indicators turn down ahead of recessions. So this, for the chart that I'm showing here, is the Conference Board leading economic index. Most people are familiar with this, and you can see that the growth rate of the Conference Board leading index reliably turns negative ahead of recessionary periods. There are a couple false signals. They're not that common, but what I'm about to show you is a way that we create sequential signals. So you could see here that the growth rate currently is negative 6.6. Never really seen outside of the economy already being in recession, which is one of the reasons why we can emphatically say that the economy is likely in recession now. Okay. The coincident index doesn't tell you where you're going, but this is how you define recessions. Coincident indicators, as defined by the National Bureau of Economic Research, include employment, income, industrial production, and consumption. So you have your four major buckets, employment being the largest one, which most people track. And what you'll notice, the difference between the leading index and the coincident index, is that the coincident index doesn't turn negative on a 6-month growth rate, which is what I'm graphing here, until the recession is already underway. If you go to the recession start periods, you'll notice that the recession actually begins when the coincident index is in the 1% range and the leading index is in the negative range. Does that make sense?
Yeah, got it.
Okay, so what we're going to try and do is we're going to try and establish some of these lead lags and just some basic triggers. So Jeffrey Moore and Victor Zarnowitz were two of the pioneers of this leading indicator type research. And what they did was they tried to create a signaling process. So the first signal, Dale, which is when you have to put your alarm bells up for the very first time, is when the leading index falls below 2%. And the coincident index can be wherever you want. But whenever the leading index falls below 2%, you have to be alert to the fact that trouble may be brewing because the leading index has fallen below trend, right? If the leading index falls to 1%, you don't know if it's going to be a recession, but you have advanced warning that a period of below trend growth may be coming. Does that make sense?
Sure.
So here I've denoted all of the times that you get this.
Who taught you that sales technique? I'm just curious. Where in your background did you have someone train you to use to say something and then end it with, does that make sense? Come on, be honest with me.
No, I'm genuinely trying to make sure that we're following along, because this can get confusing, but it's extremely important, and it's going to get even more important if you let me go to the next signal here.
Okay, does that make sense?
Does that, you got to say yes every time.
Told me? Okay, yeah. All right, go ahead.
Okay, so
busted.
You get a first signal when the leading index falls below trend. Now, you get a second signal when the leading index falls below 0% and the coincident index falls below 2%. Why is that the second signal? Because if the leading index falls below 0, that's suggesting that the coincident index may fall below 0 in the future. And if the coincident index is sitting below 2%, then you have a period where the leading index is negative and the coincident index is below trend. I'm going to say it again. Does that part make sense?
Yes.
Okay. So I've noted every time you get a second signal, which is leading index below 0 and coincident index below trend. So where are we today? The leading index is far below 0 and the coincident index is below 2%. So we have a deeply negative leading index and a coincident index that's below trend or vulnerable. So you have a second signal. You'll notice, Dale, that never in history do you get a second signal without there being a recession. The reason is because if the leading index is negative and the coincident index is below trend, it's almost impossible for the coincident index not to fall below zero, which is ultimately a recession. So the third signal, Dale,
so
which
the
is
blue vertical line with a little, that is the confirming signal. That's a second signal.
that's the second signal.
Okay.
And
Got it.
what so now we're going to go for our third signal, which is 100% confidence that a recession is underway. And the way that we define that is when the leading index is still below zero, meaning that the economy can't recover, and the coincident index is below zero. Obviously a recession, right?
Mhm.
As you could see, it very closely defines the actual NBER recessions, but we're doing this in real time rather than with 2 years of hindsight. So you can see how you get progressive signals on growth is going to slow down, growth is likely to go into a recession, growth is in recession. Does that pencil out?
Yeah. I wanted to ask Eric that, since you're getting the edge on conventional economists, how do your clients use this information, on, business, whoever, you might have institutions. Do they use this for, preparing by maybe layoffs or cutting costs prior? What's the advantage of knowing early about something that's going to happen?
So
Go ahead.
putting some numbers on this, which will help answer that question. On average, you get a signal 1. So you get your first signal on average 13 months before the recession starts.
Wow.
So whenever you get a signal 1, you can alert your clients. Let's say I'll use one client as an example. That's a manufacturing company.
Okay.
I can alert them to the fact that there might be a recession a year in the future. We don't exactly know because, as the chart shows, sometimes you get a signal 1 without a signal 2, but you never get a signal 2 without getting an actual recession, right?
Okay.
So you can alert them to the fact that, hey, things look like they're going to soften. It's time to prepare. And 13 months is certainly sufficient for even a big ship to move, like a manufacturing company.
Yeah.
You get the signal 2, which is your signal to your either money manager or to your board or to the manufacturing company is, we are 100% going to have a recession, and the average lead time from a signal 2 to a recession is 6 months.
Yeah.
So when you get a signal 2, you have 6 months. Now, Dale, this is the part that's extremely critical. You get your signal 3, which is your real-time, guaranteed, nobody can dispute it. Everybody's hair is on fire because basically what that signal 3 is that labor is negative, right? Job growth is negative.
Yeah.
There is a 2-month lag. So the best we can do in real time is a 2-month lag. So 2 months after it actually begins, but most people don't realize it for longer than that. And then the NBER doesn't tell us for over a year. So if we can define a recession with a 2-month lag on average, that's pretty good.
Yeah,
so what that means is there's an 8-month pocket between when you get a signal 2 and when you get a signal 3 on average. And what that pocket really is a guaranteed recession, but nobody believes it yet, which is the pocket that we're in now, because we've had the signal 1 triggered 12 months ago when the average is 13, and the signal 2 was triggered 5 months ago when the average is 6. So we're,
Yeah.
It's potential,
So-
it's already started. It's potential,
Mhm.
it's 1 or 2 months away. These things are impossibly difficult in real time. And also we'll have revisions that may skew this, but we're in a pocket now where a recession is virtually guaranteed, and it could be underway already, likely is, but the market doesn't realize it yet. And these are the pockets that you refer to in pre-recessionary periods, like the period from, for example, you got a signal 2, Dale, in July of 2007. But most people
Yes.
didn't realize the economy was in recession until really the second quarter of 08. And there were large rallies that happened like we're seeing
Yeah.
today. But that is the way that this information would be used. Now, it's difficult for me to articulate a trading strategy around this because everyone is completely different and has different priorities and strategies and risk management systems. And
Plus
all
it's
the rest of it.
difficult,
And
period.
plus it's difficult. It is difficult.
So can I ask you if there's anything in your data, the big debate, the narrative, and even no landing got into the narrative for a little while, still out there. Is there anything in your data that tells you the severity of the guaranteed recession?
So one of the things that we can do is just look to the magnitude of the decline in the leading index so far, which has been pretty sharp. We don't exactly know the magnitude yet because it really depends on what crises hit as a result of the recession. I feel like it shouldn't have to be said, but I think it does. A recession causes the unemployment rate to go up. The unemployment rate going up doesn't cause the recession. So the recession begins, and then the unemployment rate goes up. And whatever landmines are exposed as a result of the unemployment rate going up and people and businesses defaulting is a large contributor to the severity of the recession. That is very difficult to know with a business cycle type framework because I'm not getting into the nitty gritty of what toxic assets specific banks are holding, as an example.
Well, how about a credit crunch? You've seen most recessions come with credit being more restrictive. And
Right.
that doesn't really
Right.
fuel growth.
Right. So I'm ducking and dodging your question a little bit because magnitude's the hardest thing to guess. But I'll improve my answer a little bit. There's a couple of things we know about the magnitude. One is how fast does the Fed start cutting rates after the recession begins? Right? The lag of the Fed. And this is particularly problematic because the Fed needs to be cutting rates aggressively when you get a signal 2. Because when you get a signal 2, you're going into recession and there's nothing that anybody could do about it. We got a signal in July of 2007, as I mentioned. The Fed had paused interest rate hikes in the summer of 2006. So the Fed was on pause for a year. And then we got a signal 2. And then the Fed started cutting rates. Actually, about that time in the summer of 2007 is when the Fed started cutting rates, and the economy still went into a deep recession. What's extremely troubling today is that we have a signal 2. A recession is either imminent or already started.
And we haven't even paused.
And the Fed is still tightening. And Dale, all of this data that I'm showing is as of February. So this does not yet reflect anything with the Silicon Valley Bank or regional bank crisis more broadly, which you could argue is neutral at best and negative at worst. So we have a Fed that's still tightening and a private credit crunch that still hasn't been reflected in this data. And what's concerning is that a lot of people are saying, we have to wait to see how this plays out, to see if the economy is going into recession, when the economy was probably already in a recession before that event even took place.
Got you. All right.
And then, I just want to round out a couple more slides that I showed in my last weekly email,
Okay.
which you said that you were on. I'm not sure if this was in it or this was behind the paywall, but everyone is saying that the labor market is still too strong, which is why we get this 8-month lag between the signal 2 and the signal 3. But job losses always begin in the cyclical sectors of the economy. The total non-farm payrolls, the headline number that everyone reacts to every first Friday of every month, that doesn't usually turn negative until on average 2 or 3 months after the recession already began. The cyclical jobs, which is what's really tethered to these leading indexes, because the leading indexes are very sensitive to manufacturing and construction and trucking and things like that. The cyclical jobs lose, or the cyclical part of the economy loses jobs first. So when we look at the what I would define here as the cyclical sensitive jobs basket, which would be manufacturing, construction, trucking, and temporary help, 26 million payrolls, not an insignificant amount. We've lost 65,000 jobs cumulatively over the last 5 months. So there are job losses happening in the manufacturing sector, the construction sector, the trucking sector, and the temporary help sector.
It's interesting you say that, because pull up cat, pull up deer, a lot of these stocks that have to do with exactly what you're talking about, tractors for building things we live in and work in. Those issues have been under severe pressure.
That's exactly right. So that is why I would have increased confidence that, okay, we're clearly in this period where we're in this lag between a signal 2 and a signal 3. It's extremely dangerous because the chances of not getting a signal 3 or a recession, at least based on history, is 0. And we have no upturn yet in our leading indicators, and our cyclical sectors are hemorrhaging jobs currently. So all of that put together is an extremely high probability setup here, and the fact that the market's not realizing that is quite dangerous. So I'm not a trend follower. Obviously, I take a longer term view here, but I thought this may help clarify and also set the record straight as to why some people may say, well, you've been negative for quite some time. Well, over a year ago is when we got our first signal, which is when I began to alert clients and public appearances of a pending recession. And the timetable that I gave was roughly Q4 of last year, the beginning of this year. Difficult to do in hindsight, but based on the way that the data is playing out, it's unlikely in my view that the economy is not in recession currently or will be in the next month or two. And it's really just a matter of time until the market figures it out, unless the last 60 years of history and data are not true.
What a profession. They hope you're not right, and then when you're early, they're upset that you're early.
It's a tough job, Dale. It's a tough job.
Can't please all the people all the time.
No, but what I can promise to my clients, which is different than a lot of people who are more focused on market movements and asset prices, and understandably so. But I am not swayed at all by rallies in the market or a lack of a crash or whatever it is. I'm exclusively looking at the data. So while I got a signal a year ago, which maybe for someone trading the S&P is wow, you were so early on that. But if you're a manufacturing company managing inventory on multi-month cycles, 12 months is not that long of a lead time to sort of get your ship in order.
Eric, so, it protected people plenty during that decline we had in the market in 2022. So just because we haven't had a crash doesn't mean that there's not a lot of stocks people were in that hopefully they got out of that have lost 70-80% of their value during that time post bubble. So, I wouldn't even listen to them
and
because we haven't had a market crash. Go ahead.
And you could see in the chart here that all of the white space, which is a majority of the time, is when you don't have any signals and you're free to take as much risk as you like. But, even during the times when you get just a signal one, the 1996 period, there was softness in the market. 1998, they obviously occur for a reason. In 2016, we had oil go to $20 a barrel. So, when you get a signal one, it's possible that there's a false signal, but usually it comes with some sort of weakness in the market. It's just a time to be alert. But when you do get this signal too, which is a really deep contraction in the leading indicators and the coincident indicators that are moving towards zero. So the other thing is, this data, as I mentioned, is only updated as of February because what's included in this coincident index would be the consumption numbers for March, which we haven't gotten yet. We'll get retail sales on I believe it's Friday, which will give us some indication, and industrial production. We'll get that updated on Friday as well. And again, those numbers are, quasi pre-post SVB. So we still kind of don't have that impact yet.
Yeah.
And we're already seeing this type of setup here. So
guess on longevity once it's recognized. Couple years, 18 months, average.
Average is 12 months once it's realized. So as a default, I would move somewhere towards 12 months. But what I would say is that eventually, Dale, I'll come on your program and I'll give you my sequential triggers of recovery, because we can do this process exactly in reverse, which would be something to the effect of leading index above zero while coincident index is still below zero. And you can map these steps just going in the other direction. But the first step before we could even begin to talk about a potential recovery would be that you need the leading index to move above zero. And we're not even close to that. So I don't think a recovery would not be in the would he be on the table at the moment? So
not on the table, but economists and traders still have to live in the future.
And other things that traders could think about as a way to use this information is I would say that the information on these signals is the least timely for the equity market, because the equity market tends to react kind of late, I think, across all asset markets.
It's like that last snowflake is a tipping point before the avalanche, and snow could build forever.
Yeah, I think the interest rate market is a little bit more timely. But just to give kind of ideas of where I think the market is, even the rates market, which could be more leading and some of this stuff, is that in the average recession, the Fed cuts rates, the year over year change in the Fed funds rate is somewhere between negative 300 and negative 400 basis points year over year. That's like the peak of the rate of change of cuts. So let's call it 350 basis points on average. So hypothetically, if the Fed were to start cutting rates in September of 23, and they got to a peak rate of 5, that would be, and this is again just total averages. That would mean that in September of 24, the year over year Fed funds rate could be minus 350. It could be 1.5, right?
Yeah.
And the interest rate market is pricing it currently at about 3.5. So there's 200 basis points potentially between where the Fed funds could be in September 24 and where the market is pricing it in September 24.
Hey, Eric, I'm Dale. I'm sorry, I hate to interrupt, and I'm not sure if you answered this question or if you guys talked about this, but I wanted to get your personal opinion here. Do you believe that the Fed is or would cut rates with inflation well above 2%? Are you in the camp that the Fed would rather boost growth or support growth and try to avoid a hard landing by cutting rates despite inflation still being elevated? What's your personal thoughts there?
Yeah, that's the trick question there.
Right.
I think that they are worried about inflation, which is why they're late this time to a situation where I think they already would have been cutting. So I think they are already late, but by the time they get around to cutting, which will be, I think, maybe late summer, inflation is not going to be
Solved.
the topic of conversation. There's one historical truism of economic cycles is that inflation doesn't go up during recessions. It can go up after the recession. Like that's what we saw in the 70s, where we had recessions which knocked down inflation, but then it sort of resurged after the recession was over to new highs. So the direction of inflation is already heading down. We had inflation on like a 6-month basis peak at 10.5% in June of 22. We're at about 4.5% now. And we haven't had the recession yet. So when the recession begins, which everyone will realize when the economy does lose jobs, inflation will be, I think, 2% and below pretty quickly.
Wow.
Okay. All right. Thanks. And sorry, I didn't mean to interrupt Dale.
So yeah,
it's
I think by the
anytime.
time by the time they're pressured to cut, they'll have more than enough cover to do so.
Got it.
Cutting
Okay.
rate stabilized the real estate market, which I don't even know how much, what state it's in. I'm in California. It doesn't look like we're having a crash here.
Yeah, it depends what market you're talking about. Commercial real estate looks a little bit more problematic than single
Residential.
family. But single family does look to be under pressure in certain parts of the country. There's a tremendous build out of multifamily, and all of this commercial and multifamily was financed mostly through these small and regional community banks, not the top 25 banks. So
There'll be less supply.
If you look at the chart here, if you exclude the COVID recession, which I think you have to do because it really wasn't there were elements of it that were not, traditional business cycle recession.
Yeah.
We haven't had a traditional business cycle recession since 07, 08, and then before that 2001. And what occurred in every recession basically was the Fed cutting rates, but not really helping immediately, because when banks decide to contract credit, they do it really irrespective of the Fed cutting rates, because, everyone says, well, as soon as mortgage rates drop to 5%, the housing market's going to take off, as an example of a narrative that we hear, right? Well, what if mortgage rates go to 5% because the Fed cuts rates as a result of everyone losing their job? Then all of a sudden the rate is going down, but there's less people qualifying to be able to use that rate, right? So you have a situation in a recession where credit contracts irrespective of rate cuts. So I think that's going to be the situation that develops. Is I think the Fed's going to cut.
Who cares what the rate is if you can't get the credit?
Exactly. That's exactly what it is. So I think that when the Fed cuts rates, it's going to be a more traditional business cycle recession. I mean, this is really developing like a traditional business cycle recession because the monetary tightening was so extreme. So the slowdown is proliferating through all of the sectors that you would expect as a result of monetary tightening, namely construction and manufacturing. That's where we're losing jobs. That's where we're getting the signals. So this to me is very much a business cycle recession. Personally, I'm not dissuaded by the market performance. I just believe that we're in this gap between signal 2 and signal 3, which is on average an 8-month gap, which is, as a business cycle economist, I'm looking at this chart, and the gaps between the blue line and the red line don't seem that big. Right? You say, oh, it would be easy. I'm just going to short the hell out of everything at the blue signal. But 8 months then in trading terms can feel like an eternity because everybody wants to be right every 6 weeks, right?
Every day.
Really, exactly. Yeah. I mean, 6 weeks would be a long time for most people. So what I would say is that, from a business cycle standpoint, 8 months is not a long time.
No.
We got the signal on a signal 2 was December of 2022. So
Okay.
we are, if you use April, because this will continue to get signals for the next 2 months, it's almost
Yes.
impossible that the data is going to accelerate to that extent. So we'll basically be 5 months into a signal 2, which is 6 month average to recession start. So we're just about there.
Follow Eric at EPB Research.
Eric,
And oh,
hey
go
Dale.
ahead. Hi.
I just didn't want to interrupt before. Hi, Eric, Steve here.
Hi.
A couple of questions for you. You touched on a couple of subjects. First of all, I have no disagreement on your analysis. I think we're on the same page. But the question for me is the following: how low do you think inflation can go due to a recession? Because somehow I doubt that it's going to slip back below 2%. You said that inflation always drops during a recession, and yes, that is the case. But we still have a long way to drop to get sub 2%. So do you think we're going to practically be seeing a stagflationary period?
Historically, inflation drops about 500 basis points in the average recession. So we're about 4% now. So it's conceivable to me that if the Fed allows a business cycle recession, which certainly looks like they are, despite everyone, including my sort of fear of a panicky premature stimulation, it's conceivable to me that we would slip into deflation if the economy went into recession and we didn't see any repeat of a if they didn't start sending checks to everybody. I would say that to put it black and white, and this is a little bit of a reductionist statement, so take it with a grain of salt, but the Fed can do basically nothing to stimulate inflation. The inflation that we saw came from the fiscal side. So the Fed can slam rates to zero and inflation's not really going to accelerate if we have a recession. It's basically, to me, it's very conceivable that if we have a business cycle recession, unless we see, aggressive fiscal handouts again, we'll probably slip into deflation.
Okay. Okay, let's see about that. I'm a little bit worried that in this case, this might not be the case. I'm afraid the chances of a stagflationary period are higher than they've been in the past, to say the least.
Well, it's all predicated on labor, right? So we've seen a pretty significant drop in inflation so far. Hasn't come all the way back down to where it needs to, no doubt about that. But we haven't hit the part of the cycle where inflation really starts to crater. Now, I would also remind everybody, if I was to do a signal 4 would be inflation, right? Because growth leads inflation. Inflation is a lagging economic indicator. I wish I had the chart to articulate this point, but Dale, how many years on average, or months or quarters, do you think inflation takes to bottom after the recession is over?
Couple years.
It's about 2 years, right? So, one, again, proximate example would be that we had the recession in 2009 and inflation bottomed in 2011 and 12, right? And the reason for that is because of the labor component that lags and then all of the filter through effects that happen through rent and all the things like that. So if we have a recession here in the first quarter of 23 and it lasts a year, this is, again, a super straw man type timeline. So please don't take this with a grain of salt. But if we have a recession that lasts a year, that would take us to 2024, first quarter of 2024, which means that the bulk of the decline in inflation is going to happen in 2024 and 2025.
Okay.
And that's when you'll see the trough in inflation. And again, the Fed was cutting rates starting in 2007, but inflation troughed in 2012. So it's not the rate cuts.
Yeah, and the example that really is frightening is that the Fed was on pause. When was it? 2007
That's
for a
right.
year
They
before.
paused in the summer of 06.
Okay, for a year. And even though they paused for a year, we had a pretty good hit to the economy, and we're not even at the pause.
Which
We're
is
not even at pause yet.
which is to me most. It's impossible to pin this down to any one cycle that looks familiar, because it's
There aren't any.
You
Are
have
there?
there's components to every cycle that are similar. I mean,
Yeah.
it's really like an amalgamation of like all these different cycles, but one one analog that keeps appearing over and over is the 1974 recession to me.
Okay.
Because that was the last really inflationary recession where real growth fell much more precipitously than nominal growth, which gave corporations what's called the money illusion, right? Where revenues are growing 10%, but unit volume is falling 2%, right?
Yeah.
So you're selling 2% less in terms of the number of goods, but the revenue is 10% higher. So you say, oh, I could still pay the employees because I pay the employees out of revenue. But really what's happening is the productivity is collapsing because those employees aren't producing more units.
Yeah.
And then once the inflation craters in the recession is when you have this sort of flush of labor. Dale, in the recession of 1974, the start date was December of 1973. Okay.
Okay.
When was the first month of job losses?
I can't remember. I was 11.
It was August of 1974. So it was 8 months after the recession started. So there was a huge lag to labor. A lot of different reasons why. One of the reasons that to me is curious is the inflationary aspect to it, where nominal growth has lingered longer than real growth because of this. If you go back to our coincident index here, real growth has been below 2%, back to where it has been historically for many, many months at this point. It's the nominal growth that's sort of hanging in because of the inflation component, which I think is causing a lag to labor in a similar fashion to 1974. One more factoid, Dale, and then you can kick me off the air, is in the 1974, just to give you an idea of how fast the change in labor was, I think it was in July of 1974, payrolls were positive 20,000, plus 20,000 in July. In September, it was minus 700.
Wow.
So in 2 months, it went from plus 20 to minus 700. And those are on, a different population base. So it's, give me some leeway here, but it's virtually the equivalent in today's numbers of something like plus 50 to negative 1 million in 2 months.
Okay, let's wrap it on that potential important event that people will be reading about, and you told us about here, Eric, and appreciate once again you coming here to clarify the dark science of economics and edify the F.A.C.E community. We appreciate what you do for our community, and keep up the great work, and follow Eric. Follow him on Twitter, check out his newsletter. Eric is taking off like we hope the economy does once again someday. So,
thank you, Dad. I appreciate you always having me on. You guys can just go to epbresearch.com, and then there's a free newsletter. You can just type in your email, and you get about one or two notes a week I'm putting out, which kind of gives some color and through the lens of the business cycle.
Yeah. So again, thank you so much, Eric, and rooting for your forecasts and all your clients that were prepared for the flood before it came.
Thanks, guys. Appreciate it. Talk soon.
All right. That's it, everyone. You could join the team on the Morning Edge and 10 seconds. Don't just count your pips, count your blessings. See you later. Thanks again, Eric.